Hello everyone, and welcome to the fourth lesson of this workshop. We will talk about two topics. The first one is seasonality. That is why we can make money on some commodity opportunities every year. We will also take a look at the technical analysis. It is a simple yet incredibly helpful tool. I'm pretty sure this lesson will be much easier to understand than the previous one. But once again, I have to remind you, this video is not investment advice. If any financial instruments like futures, spreads, ETFs, options, or others are mentioned anywhere in this video, it's always just for educational purposes. Now let's start and explain what seasonality is. Seasonality is a tendency of some commodity to move in a certain way over a specified period every year. Maybe it sounds complicated, but trust me, it is not. An example would be worth 1,000 words. Let's take a closer look at tomato production in Europe. The weather is obviously not kind for growing tomatoes in late autumn and winter under the open air, but we can still buy fresh tomatoes even in winter. Some of them are imported from countries like Morocco, but the majority is produced within Europe in heated greenhouses. Notable producing countries are Spain, Italy, Portugal, and the Netherlands. This type of production is naturally more expensive, and the production capacity is also constrained by the number of greenhouses. Moreover, the supply is somewhat price inelastic. Even if demand increases, it's not easy and cheap to build more greenhouses to meet the additional demand. These factors contribute to higher tomato prices in winter and late autumn. However, the situation suddenly changes in spring. Favorable temperatures and pleasant weather bring new supplies from normal fields to the market. And even if demand is strong, smaller farms that are more flexible than large agribusinesses can plant more tomato plants. Sure, demand goes up too, especially in summer, as people tend to eat more salads and the grilling season is in full swing. But this is somewhat offset by homegrown produce. Overall, the ability to grow tomatoes relatively cheaply during the season results in much lower prices. What I just said makes sense, but let's back the talk by data. Here's a chart showing average monthly tomato prices in Europe. The green curve is the average price over the previous 5 years. The black dashed curve highlights the minimum prices over the same period, while the black dotted curve the maximum prices. You can clearly notice the seasonal trend in price I described a moment ago. The prices are generally high in winter and low in summer. Before moving on, notice the price in 2022, which is the solid red curve. The average price in February was well above the range in the previous 5 years. It was also higher than in January 2022, seemingly contradicting the prevailing seasonal trend. We will talk about this later in this lesson. Now, you might wonder what the cause of seasonality is. It is the inhomogeneity of supply and demand over time. However, it's crucial to realize that seasonality is not just some random inhomogeneity, but rather one that periodically repeats each year. When the supply cannot meet demand, it pushes the price higher. On the other hand, insufficient demand or overwhelming supply causes the price to fall. I stressed that seasonality is about periodicity. While there are numerous socio-economic cycles, their reliability is not great. So what is the most reliable thing that repeats every year? Yes, it's the weather. Of course, I don't mean day-to-day changes. Instead, I have the season of the year in mind. The laws of nature command these meteorological cycles, which is the reason why seasonality works so well. But this does not imply 100% reliability. Even the summer can sometimes be really cold and winter pretty mild. Nevertheless, we can all agree it is very unlikely to snow in the US during summer. The seasons of the year are closely related to production cycles. For example, corn in the USA is planted in spring and harvested in autumn. We already talked about corn in previous lessons, but don't forget that seasonality is not a precise phenomenon. farmers do not start the planting or harvest on exactly the same day every year. The weather and crop conditions differ slightly every year, and from time to time, seasonality can fail altogether, but more about this later. There are a few types of seasonality analysis on spread charts. Today, I will show you 2 of them to you. You can learn about the rest in the Spreadcharts app tutorial on spreadcharts.com. Right now, you are looking at seasonal curves or averages. This is the most convenient way to visualize seasonality. The blue curve is the price of the selected contract, which is March 2020 in this case. The red and green curves are the averages. By the way, these are not regular averages. They are weighted averages that are scaled and shifted in the end. Please refer to the app tutorial for a detailed explanation. For now, it's essential to remember these curves are calculated from historical data, specifically the last 5 and 15 years in the case of this particular chart you see here. They show the prevailing seasonal trend in the past. In this particular case, you can see the price of corn tends to drop between June and September every year. The most common explanation you can find on the internet is that this is the impact of harvest. The theory says the market expects a lot of new supply coming, forcing the price to go down. However, this explanation is wrong. Still, many people believe it. But when you think about it for a moment, you will realize its fallacy. Why the price drops exactly between June and September if the market knows about the harvest well in advance? So why does the price not start falling earlier? Or why is there any drop at all, as the market can factor in the harvest from the beginning? The explanation is simple. The market is not dumb. It knows there will be a harvest, but it doesn't know the size and quality of the new crop. For example, the weather can be extremely dry and damage the crop, resulting in low yields per acre. Therefore, the market always adds some risk premium to the price of contract from the new crop. After the planting, we gradually get more information about the state of the crop as the plants grow. The risk that something bad happens becomes lower as the time passes, prompting the disintegration of the risk premium. As this premium or surcharge disappears, the price moves lower. Of course, there are years when something bad like drought or floods truly happens, but these are rare. Most of the years the crop is fine. That is the reason for the seasonal downtrend in corn you see on this chart. Let's move to the second type of seasonal analysis. Here you see the stacked seasonality chart. It shows the actual prices for this particular expiration month over the past 10 expiration years stacked on top of each other. The individual contracts are distinguished by color according to the chart's legend. This chart allows us to study every single year in detail and compare it to past years. The actual chart in the Spreadcharts app is interactive, allowing us to hide any number of contracts we don't want to see. This can offer better clarity and filter abnormal years. You can see it demonstrated in the following charts. We can spot the seasonal downtrend between June and September. But unlike the averages, it might be harder to recognize the overall seasonal trend on the stacked seasonality chart. It is more useful for detailed analysis. Although seasonality looks great, it can fail like any other tool. There is no silver bullet. Some years may be abnormal, typically due to bad weather or export restrictions. Even more dangerous are the permanent shifts in seasonality. No matter how strong the phenomenon causing the seasonal trend is, it can suddenly end or disappear for a couple of years. What can cause such a dramatic change? First of all, changes in the long-term climate cycle like El Niño and La Niña can impact the market. Even more long-lasting are the fundamental changes. For example, demand for corn has permanently increased due to the mandatory blending of bioethanol into gasoline. On the other hand, corn yields dramatically increased in past decades thanks to new technology like fertilizers, chemicals, and genetically modified crops. Another example is the new fracking technology that unlocked vast new supplies of crude oil and natural gas. To be precise, we knew about most of these deposits before. They were just uneconomical to extract with the old drilling technology. And finally, turning to industrial metals, the widespread adoption of electric vehicles will cause an explosion in demand for copper, nickel, and other materials. All these fundamental shifts irreversibly change the corresponding markets and upend the decades-old seasonal trends. The problem is that we always recognize the change in retrospect. The impact of new tech is always marginalized and its emergence. Even the professionals in those fields usually fail to recognize the fundamental change early on. Of course, we are not experts on drilling or chemicals, so how can we anticipate such changes? The answer is we cannot. All we can do is properly manage our risk. This way, we do not lose much when the market fundamentally changes. Many traders do not realize this and they suffer horrendous losses when the seasonality fails. Luckily, there is a simple solution. We are not going to use just seasonality. Despite being a great tool, it reflects only the historical trends. It tells us nothing about the current state of the markets. Yet many people use seasonality exclusively as it is easy to comprehend. It's hard to resist those nice seasonal trends, especially when the historical statistics look great. We often compare purely seasonal trading to driving a car by looking just in the rearview mirror. We can all agree it is not a good idea. Sooner or later, you would smash into something. In trading, this obstacle can be a sudden change in the market, which the seasonality cannot show us. Let's show two examples of failed seasonality in practice. The first one is Lean Hogs, specifically the June 2019 contract. Especially the seasonal downtrend in spring is well apparent, but you can see what the price in 2019 actually did. Remember, it's the blue curve. It moved in the exact opposite way to seasonality. What was behind this? The unseasonal growth was caused by the African swine fever spreading in China, decimating pigs' herds on a massive scale. And here's the second example. It is the July 2019 corn contract. There are a few seasonal deviations, but the most important one is the seasonal downtrend at the end of spring at the beginning of summer. Yet, the price shot higher in 2019. It was caused by bad weather in the USA that delayed planting that year. This resulted in fears about the quality of the new crop, sending the price sharply higher. There is one interesting fact in both of these examples. Although the price action could not be predicted by seasonality, it was possible to avoid these traps. The COT analysis warned us that price could evolve differently from seasonably. So, combining multiple types of data and using the right tools does work even in such difficult times. Now, let's sum up everything we have learned about seasonality. It is very hard to distinguish common volatility from a major change in the market, and it's practically impossible if we use just price charts or derive studies like seasonality. So, if a trader uses just seasonality and holds a losing positions for too long, there is a risk of a catastrophic loss. His logic often is like, the price is going down, but I will wait, it's just some random noise. The seasonal average looks so strong. Moreover, the market went up 90% of the time in this period of the past 15 years, it must turn up at any moment. That's the usual logic of people caught in a counter-seasonal trend. The truth is, the market does not have to turn up, so they wait and the loss gets bigger and bigger until they panic, sell or blow up their account. The market usually turns around soon after, making the experience even more painful. The conclusion is simple. While exclusively seasonal trading can work for a few years, I have never met even a single trader who would be successful in the long term using just seasonality. But to be clear, we do not want to trash seasonality. It is a helpful tool, and it makes a great deal of sense to include it in your trading system. It can help us filter the right opportunities and amplify our profits. At the same time, it's crucial to remember that no single tool works 100% of the time, neither does seasonality. The solution is to combine seasonality studies with other tools at our disposal. It can be the contango analysis, where we take a deep look into the market structure. We already talked about this, but we will go into more details later. Another incredibly powerful tool is commitments of traders' data, often abbreviated as just COT. This data provides a valuable insight into the sentiment on a concrete market. We will delve into it in one of the next lessons. We also have technical analysis. We will get it to in a few seconds. And finally, it can be the analysis of clearing charges for some grains where we can model it. We have talked about seasonality enough. Now let's move to the technical analysis. So, what is technical analysis? It is a method for predicting the future price action based only on the price action alone. Sounds a bit circular? Well, that's not a coincidence. Technical analysis looks for price patterns that are usually resolved in a specific direction. It does not deal with any other types of data, just price. Why being so restrictive? Well, the technical analysis is based on the so-called efficient market hypothesis. It states that other types of data are not of any use, as their impact is immediately discounted in price once they become known. Therefore, they provide zero advantage, and it only makes sense to watch the price itself. Is this theory correct? Well, to a certain degree. In reality, the markets are not entirely efficient. There are many instances when they price some fundamental data incorrectly, which creates opportunities for traders with the right data. On the other hand, such instances are hard to come by. Therefore, trading according to the news you read on the internet would not work, as this information is already factored in the price when it reaches you. This is especially true for short-term trading. There is more inherent unpredictability and therefore opportunity in the longer term. I present to you the three main concepts in technical analysis. They are resistance, support, and trend line. Let's start with resistance. Resistance is simply a barrier for the price on its way higher. The picture here is quite self-explanatory. The price tends to turn lower from the resistance. Technical analysis, like everything in trading, is about probabilities. There is no certainty here. So we are talking about a slightly higher chance the price would turn down here than at some other level. But sometimes it will just smash through it. However, if it is an important resistance, at least some kind of temporary reaction or consolidation at this level is likely. Support is a mirror-like image of the resistance. The price can turn around here when it is in a downtrend. Again, check the picture here. The third concept is the trend line. We know two basic types of lines: rising trend line and falling trend line. Let's start with the rising trend line. You can see two examples of such a trend line in this picture. It always connects at least two local extremes, either maximums or minimums. The key thing is that each following maximum or minimum must be higher than the previous one. The falling trend lines work the same way. Just the following maximum or minimum must be lower than the previous one. I would say this is clear. Trend lines can represent support, resistance, or both of them at the same time. It depends on whether the price is currently above or below the trend line. Like with every support or resistance, the closer the price gets to it, the higher the chance it will bounce off it. Is that all technical analysis offers? No, not at all. There are many more complex patterns beyond these three basic concepts. I summarized the most useful pattern in this table for you. I will not go through all of them as it would take us a lot of time. I am sure you can find them explained on the internet. While we look for some of these patterns in the markets, not all of them are as reliable. Some of them can be pretty ambiguous. Sometimes we can find conflicting patterns in one market at the same time, for example, on different time frames. If you study the technical analysis further, you will surely come across the so-called technical indicators. These indicators can be very complicated sometimes. We would like to warn you about them. Complicated things can appear smart, but that's often not true. No matter how complicated the calculation of such an indicator is, keep in mind it's derived just from price. In other words, it cannot provide any new information that you would not see in the price itself. Simplicity beats complexity in trading. This is true not just for technical analysis, but for everything basically. As Albert Einstein said, everything should be made as simple as possible, but not simpler. If you like to use technical indicators, let's go for them. But we can live without them and do not feel disadvantaged at all by using just the basic price patterns. And this is the end of this lesson, which I hope was more enjoyable than the previous one. In the next lesson, we will get to the commodity spreads. If commodities caught your attention, but you don't have a large account, you definitely should not miss the next lesson. Thank you for your attention and have a great day.